Welcome to the Deep Dive. We're here to take complex ideas, unpack them, and hopefully give you some really useful insights. Today, we're tackling something fundamental to almost every business, but the accounting side can seem a bit dense. We're looking at how companies handle their biggest physical assets.
That's right. Think factories, machinery, maybe even large office buildings.
Exactly.
We're talking about property, plant, and equipment, PPE for short. And our deep dive today is based on key parts of an article looking specifically at IAS 16.
Right. IAS 16, the international standard that governs all this.
It is.
So our goal today is to, cut through the jargon. We want to show you what really counts when a company buys or builds these major assets, how they figure out the initial value, and importantly, how they spread that cost out over time.
It's actually a fascinating window into a company's financial core, and it impacts everything: reported profits, the balance sheet. It's crucial stuff.
Absolutely. Should be some pretty illuminating points and practical takeaways. Ready to jump in?
Let's do it.
Okay, so first things first. When accountants talk about property, plant, and equipment, what exactly do they mean? Let's pin that down.
Okay. At its heart, IAS 16 defines PPE as tangible items, so physical things you can touch.
Right, tangible.
And they're held for use in production or supplying goods or services, maybe for rental or for administrative purposes. And the key thing, they're expected to be used for more than one accounting period.
So not something you buy and sell quickly like inventory. We're talking long-term use.
Exactly.
Like the actual factory building, the machines inside, perhaps the main office building.
Precisely. These are the core physical assets needed for the company's operations. It's a long-term strategy. They're not meant for resale in the normal course of business.
Okay, got it. Now, when a company gets a new piece of PPE, maybe builds a factory or buys a huge machine, how do they figure out its initial cost for the books? I suspect it's not just the price on the invoice.
You've hit on a really critical point there. It's definitely not just the purchase price. IAS 16 says PPE should initially be measured at its cost.
Its cost.
But cost is broader than you might think. And there are two key criteria before you can even recognize any cost as part of PPE.
What are those?
First, it has to be probable, likely, that future economic benefits tied to that item will flow to the company.
Makes sense. Has to help make money somehow.
Basically, yes. And second, the cost itself has to be reliably measurable. You need a solid number.
Right. Can't just guess. Okay, so if those two conditions are met, what goes into this cost? This is where it gets interesting, I think.
It does. So the cost includes several things. First, obviously, the purchase price.
Okay.
That includes things like import duties, non-refundable purchase taxes. But after you deduct any trade discounts or rebates you got.
Got it. Net price.
Then second, you have what are called directly attributable costs. And this is a big category.
Directly attributable,
Meaning costs that are absolutely essential to get the asset to the location and condition needed for it to work as management intended. Think of it like this. You wouldn't have spent this money if you hadn't bought or built this specific asset.
Ah, okay. Like what specifically?
Well, things like employee benefits, salaries, wages, but only those arising directly from constructing or acquiring the PPE.
So the construction workers' wages, for example.
Exactly. Also, site preparation costs, initial delivery and handling, installation and assembly costs.
Putting it together.
Right. Costs of testing to make sure the asset works correctly.
Yeah.
Professional fees, too, like architects or engineers involved in the construction.
Wow. Okay. That's quite a list. What else?
And third, there's the initial estimate of the costs of dismantling and removing the item and restoring the site later on.
So cleanup costs at the end of its life. You include that at the beginning.
Yes, but only if the company has an obligation, like a legal requirement, to do that restoration.
Yeah.
And you don't include the full future amount. You include its present value.
Discounting. So the value of that future cost in today's money.
Precisely. Using an appropriate discount rate if the effect is material.
So it really is everything directly involved in getting it ready to, make money. But you mentioned a cutoff point. Getting it ready for use. Why is that timing so crucial?
That cutoff is vital. Costs can only be capitalized, added to the asset's value, until the asset is in the location and condition necessary for it to be capable of operating in the manner intended by management.
Even if it's not actually running at full speed yet, like if demand is low.
Exactly. Even if it's not at full capacity. Once it's capable of operating as intended, you stop capitalizing costs related to its acquisition or construction.
And costs incurred after that point.
They're generally expensed as incurred. They hit the profit and loss statement straight away. This distinction matters a lot for reported profits versus asset values.
I see. And what about mistakes, like if something goes wrong during construction?
Good point. Abnormal costs, like significant amounts of wasted materials, labor, or other resources due to inefficiency or errors, cannot be included in the cost of the asset.
So if a digger hits a pipe by mistake, the repair cost isn't added to the factory's cost.
Correct. That would typically be expensed immediately. It's not part of the normal cost of getting the asset ready.
Okay, and you mentioned borrowing costs earlier. That seems quite specific. How does interest on loans fit in?
Yes, that's covered by a separate standard, IAS 23 borrowing costs, but it links directly here. If a company borrows funds specifically to finance the construction of a qualifying asset like our factory, then the actual borrowing costs, the interest incurred during the construction period, can be capitalized.
Added to the asset's cost instead of being an expense right away.
Exactly. It becomes part of the asset's value on the balance sheet. If they use general borrowings, not a specific loan, they have to apply a capitalization rate, usually a weighted average of their borrowing costs, to the expenditure on the asset.
Interesting. So financing costs can become part of the asset itself.
During construction, yes.
Now, just as important, what costs are definitely not allowed? What gets charged straight to profit or loss? No question.
Right. The standard is quite clear on some exclusions. Costs of opening a new facility, think grand opening parties, initial advertising.
Marketing stuff.
Yes. Also, costs of introducing a new product or service, even if it uses the new asset. Costs of conducting business in a new location or with a new class of customer that includes staff training for these new operations.
Staff training is out.
For conducting business in a new location or with new customers, yes, that's considered an operating expense. And finally, administration and other general overhead costs are explicitly excluded.
So no allocating a portion of the CEO's salary to the cost of the new machine?
Definitely not. It has to be directly attributable costs. General overheads don't qualify.
Okay, this is a lot of rules. Let's make it concrete. You mentioned Omega Co. building a factory. How does their situation illustrate all this?
Omega Co. is a perfect case study. They built a factory over a period, incurring lots of different costs. Instead of getting lost in every single calculation right now, we could put the detailed breakdown in the show notes for anyone who loves the numbers.
Great idea.
Let's focus on the types of costs and why they are included or excluded based on the principles we just discussed.
Sounds good. What were the key ones?
Okay, so they bought the land. That's clearly direct purchase.
Yep.
They had costs to dismantle old structures on the site. That's site preparation.
Yeah.
Directly attributable. So included.
Makes sense.
Purchase of materials to actually build the factory. Clearly essential. Included.
Right.
Employee costs. Now, this was interesting. They incurred costs over 9 months, but construction only took 8 months. So only the 8 months of costs directly related to construction were capitalized. The last month was an operating expense.
Ah, that highlights the direct contribution point.
Exactly. Then production overheads related to construction. Most were included, but they had an abnormal cost, $200,000 from fixing damage after a gas leak. That $200,000 had to be excluded. It was expense.
Because it was abnormal, an error.
Precisely. General administrative overheads they try to allocate, disallowed, zero capitalized.
As we just discussed.
Architect's fees directly for the construction, yes, included. Professional fees directly related. Cost of relocating staff to work at the new factory. Excluded. That's about staffing the operation, not building the asset itself.
Right, operating costs.
Cost for the formal opening party. Also excluded. Marketing promotional.
Got it.
Loan interest. They took out a specific loan for the factory. So the interest during the 8-month construction period was capitalized. Interest after construction stopped being capitalized.
Following the IAS 23 rule.
Correct. And finally, those future restoration costs. They had a legal obligation to demolish the factory in 20 years and restore the site. They estimated the future cost and calculated its present value using an 8% discount rate. That present value amount was capitalized.
Adding a future obligation to the initial cost? Wow.
It reflects the true cost of ownership over the asset's life cycle right from the start.
So when you add up all the bits that are allowed under IAS 16, Omega's factory cost comes out at $20,730,000. This really shows how specific the rules are. What's the bigger picture here? What does this detailed calculation really tell us?
It tells us that the number on the balance sheet for that factory isn't just plucked out of thin air. It represents a very specific accumulation of costs deemed essential to bring that asset into existence and readiness.
And anything not meeting those strict criteria hits the income statement immediately.
Exactly.
Right.
It directly impacts that year's profit. So these capitalization decisions have a real effect. Capitalizing more makes current profit look better, but results in higher depreciation charges later. Expensing more hurts current profit, but means lower future depreciation.
So it influences the timing of profit recognition.
Absolutely. And the unwinding of that discount on the restoration costs we mentioned, that hits finance costs each year over the asset's life, gradually increasing the liability and recognizing the time value of money. A very thorough system when applied correctly.
Okay, so the factory is built, it's on the books at its initial cost, but assets need upkeep, right? What happens when the company spends more money later? Repairs, maintenance, maybe upgrades.
That's the next key area, subsequent expenditure. IAS 16 says you should only capitalize subsequent costs, add them to the asset's carrying amount if they meet the same recognition criteria we discussed for initial costs.
So probable future economic benefits and reliable measurement.
Exactly. If the spending is likely to generate additional future benefits beyond what was originally expected, or extends the asset's life, or improves its quality or output significantly, then you can capitalize it.
And if it doesn't meet that threshold, like routine maintenance,
Then it's treated as a repair or maintenance expense. It goes straight to the profit or loss statement in the period it's incurred. Think day-to-day servicing, oil changes, minor repairs. Those are just the cost of doing business.
So let's say you replace a major part of a machine, like a furnace lining that wears out. That could potentially be capitalized.
Yes, very likely. If the replacement is significant, enhances or restores future benefits, and its cost is reliable, you capitalize the cost of the new lining.
And what happens to the old lining's value on the books?
Good question. When you capitalize the replacement part, you must derecognize, remove the carrying amount of the part that was replaced. Even if it wasn't tracked separately before, you'd estimate what its carrying amount was.
So out with the old, in with the new on the balance sheet as well.
Precisely. And that new capitalized part, like the new lining, would then be depreciated over its own useful life.
Okay, that leads us perfectly into depreciation. Now this term, lots of people think it just means the asset is losing value, like a used car. But that's not quite the accounting definition, is it?
You're right, that's a very common misconception. Depreciation in accounting isn't primarily about tracking market value decline. IAS 16 defines it as the systematic allocation of the depreciable amount of an asset over its useful life.
Systematic allocation. Okay, break that down.
It's an accrual accounting concept. You buy a big asset that will generate benefits for, say, 10 years. Instead of expensing the entire cost in year one, depreciation spreads the cost over the 10 years you expect to benefit from it. It matches the cost to the periods that benefit.
So it's about matching expense to revenue generation over time.
Essentially, yes. Matching the consumption of the asset's service potential with the periods it benefits. That's why even an asset that might be increasing in market value, like some buildings, still needs to be depreciated if its economic benefits are being consumed.
And the depreciable amount is what gets spread.
Yes, that's the asset's cost or its revalued amount if the company uses the revaluation model, which is a whole other topic, minus its estimated residual value.
Residual value being what you expect to sell it for at the end of its useful life.
Or scrap value, yes.
Yeah.
What you expect to get for it when you dispose of it, after deducting disposal costs.
And this depreciation charge usually hits the income statement as an expense, right? Reduces profit.
Generally, yes. Depreciation expense is recognized in profit or loss each period.
But you mentioned an exception earlier.
Yes. The exception is when the depreciation is allowed to be included in the carrying amount of another asset.
How does that work?
The classic example is if a company uses its own machinery, say, a construction crane it owns, to build a new office building for itself. The depreciation on that crane during the construction period wouldn't be an expense in the P&L, it would be capitalized as part of the cost of the new office building.
Because the crane's use is directly contributing to creating another asset.
Exactly. Its economic benefit is being consumed to create another asset, not just in general operations.
Now, useful life and residual value, these sound like estimates. How firm are they?
They are absolutely estimates, and they can be quite subjective based on management's judgment, experience, plans for the asset, expected technological changes, etc.
So they can change.
Yes, and IAS 16 actually requires companies to review the residual value and the useful life of an asset, at least at the end of each financial year.
And if they think their initial estimate was wrong.
If expectations differ significantly from previous estimates, the change is accounted for as a change in accounting estimate, according to IAS 8. This means you adjust the depreciation charge for the current and future periods. You don't go back and change past depreciation.
It's perspective looking forward.
Exactly. Which makes sense, as it reflects new information, but it also means changes in estimates can directly impact future reported profits.
Let's look at an example of that. We have an item of plant where the estimate's changed.
Right. This really clarifies the prospective adjustment. Imagine a plant bought for $220,000 on Jan 1, 20x6. Initial estimate. 5-year life, $20,000 residual value.
Okay, so depreciable amount is $200,000. 20K over 5 years, that's $40,000 depreciation per year.
Correct. So for 20x6, depreciation is $40,000. The carrying amount at the end of 20x6 is $180,000, 220K, 40K.
Still straightforward.
But then at the end of 20x6, management revises the estimates. They now think it only has 3 more years of useful life left, so total life is shorter, and the residual value will only be $12,000.
Okay, so things changed. What happens now?
You take the current carrying amount, $180,000. You subtract the new residual value, $12,000. That gives you the remaining depreciable amount, $168,000.
Right.
And you depreciate that $168,000 over the new remaining useful life of 3 years.
So $168,000 divided by 3, that's $56,000 per year.
Exactly. The depreciation charge for 20x7, 20x8, and 20x9 will be $56,000 each year. It reflects the revised expectations going forward.
It's also important, isn't it, that sometimes you don't just depreciate the whole asset as one lump. You might depreciate different parts separately.
Yes, that's a key requirement called component depreciation. Each part of an item of PPE that has a cost that is significant in relation to the total cost of the item must be depreciated separately.
Significant parts get their own depreciation schedule.
Correct. If an asset is effectively made up of 2 or more major components with different useful lives, you account for each component separately and depreciate it over its own specific useful life.
The example of the furnace with its lining seems perfect for illustrating this.
It really is. So, the company buys a furnace for $200,000. The main furnace structure is expected to last 10 years.
Okay.
But it has a special lining inside that's crucial for its operation, costs $50,000, and needs replacing every 5 years. That $50,000 cost is significant compared to the total $200,000.
And it has a different useful life, 5 years versus 10 for the rest.
Precisely. So you treat it as 2 components for depreciation. The lining, $50,000 cost, is depreciated over 5 years, so $10,000 per year. The rest of the furnace, $150,000 cost, is depreciated over 10 years, so $15,000 per year.
Meaning the total annual depreciation for the first 5 years is $10,000 plus $15,000, fully $25,000.
Exactly. Now fast forward 5 years. At the end of 20x6, the original lining component is fully depreciated. Its carrying amount is 0.
Makes sense.
On January 4, 20x7, they replace the lining. The new lining costs $70,000 this time. What happens?
Well, based on what we said earlier, they capitalize that $70,000 as a new component.
Perfect. The $70,000 cost of the new lining is capitalized. It's a significant replacement part.
And the old one was already derecognized effectively as its carrying amount was 0.
Right. So now from 20x7 onwards, the depreciation calculation changes again. You have the new lining, $70,000, being depreciated over its 5-year life, $14,000 per year, plus the original main furnace component still being depreciated over its remaining 5 years, $15,000 per year.
So the new total annual depreciation is $14,000 plus $15,000 yields $29,000.
Exactly. It clearly shows how treating components separately leads to a more accurate reflection of how the asset's economic benefits are consumed over time.
Okay, we've covered a lot of ground defining PPE, initial costs, subsequent costs, depreciation, componentization. So wrapping this up, what are the really big takeaways for you, our listener, trying to understand how businesses account for these major tangible assets?
Well, I think we've seen that under IAS 16, accounting for PPE is quite detailed. We started with the definition, tangible long-term assets used in the business. Then we dissected that initial cost. It's way more than the sticker price.
Right. Includes all those directly attributable costs, borrowing costs sometimes, even future dismantling costs at present value.
Exactly. And we saw how crucial the rules are for subsequent costs. Only capitalize if they add future benefits. Otherwise, it's an expense.
Yeah.
And we tackled depreciation.
Showing it's that systematic allocation of cost over useful life, not necessarily tracking market value. And that estimates like useful life can and do change.
And that significant components need separate tracking. It's all about reflecting the economic reality as accurately as possible.
And these aren't just, dry rules for accountants. They're fundamental choices that genuinely shape the financial picture a company presents. They reflect investment decisions, operational planning.
Absolutely. These choices directly impact reported profits year by year and the strength of the balance sheet. Capitalize or expense. Choose a longer or shorter useful life. These decisions matter.
So maybe a final thought for our listeners to ponder.
How about this? When you look at a company's financial statements and you see the amount they've invested in PPE, or you look at their depreciation policies, consider what these seemingly technical accounting choices might be signaling.
What story are they telling?
Right. What might the choices about capitalization versus expensing, or the estimates used for useful lives, tell you about management's view of the future, their financial strategy, maybe even their confidence in the long-term value of their investments? It's often more revealing than you might think.